I can join from my phone.
Okay. All right. If you're here with us, thank you for joining. We're waiting on our guests to be able to sign in. We have a bit of technical issues here, but hang in there with us. Today we have a guest, a special guest who is an expert in what's it called, taxes. So 1 second. She's yay. Okay. All right. Good to see you. You're welcome.
Can you
Ma.
hear me?
We can hear you. Yes.
Awesome. Awesome. Thank you. Good to
You
be here.
good to see you, ma. Good to see you. Good to see you. So we're waiting on people to join us, but so we have this on a recording. So you can go ahead and answer questions. It's being recorded, and then when we're done, if people are not mainly joining online because of work or anything, we're going to post it online anyway, so people can see this again and hear what you have to say. We're all curious. I can't wait. So please, the floor is yours. Watch and listen and let you do your thing, ma.
Okay.
So tell us who you are. We've seen the flyers, but we just want to hear who you are and, tell us about you a little.
Okay. So my name is Dumkele Anifowoshe. I hold a bachelor's degree in applied physics, but then went on to write the Institute of Chartered Accountants exam in Nigeria. So I was chartered in Nigeria before I came to the US in '99, and I wrote the CPA exams. And I practice as a CPA in the US as well, own my practice. And I've been doing this for about 14 years now solo. Before then, I worked with the state some. So I have some state audit experience in a variety of taxes. And I did a little stint with H&R Block as well to gain some more American experience. So I've been in the industry for a while. I work with small businesses and individuals, bookkeeping, compliance consulting, and tax planning.
Hmm.
Yeah.
All right. So you have a few of our questions that clients have sent to us already. I like to start from there, and basics that you think audience, the clients listening online, or whoever will stumble on this later in the future. Basic things you think they'll be curious about relating to taxes, and how you can answer those questions. 30 minutes is definitely not enough for you to answer a lot of questions, but um, do the best you can do, and then people will have your number and contact info to reach out to you for more information.
Okay. So taxes. The US tax system is a bit complex. Not a bit, it is complex.
Mm.
It is progressive tax, which means the more you make, the more you're expected to pay.
Oh.
Typically, I advise my, people I work with. I consider people I work with partners, so we can all do well together. I typically advise them you need to plan for your taxes, or your taxes will plan for you. You cannot be passive towards your US taxes. You need to be actively involved and actively engaged in knowing what's going on. So the first thing you need to do about taxes, like this is tax season, the very first thing is to gather your information very well. Documentation. The tax is about reporting. Really, the tax return we file is more of a reconciliation, because if you're an employee, your employer is already taking taxes out of your W-2, from your paycheck rather, and they
Mm.
report that of the year. So you're already paying taxes. And if you're a business person, you're expected to pay in estimated taxes. So not everyone does that, but at the end of the year, you're meant to do a reconciliation and report everything. So keeping proper records is the very first step. Keep proper records of your income, keep proper records of your expenses. If you're an employee, there's a different set of rules that apply as against if you're a business owner. Different set of rules apply as well. If you're an employee, your employer is responsible for half your social security and half your Medicare tax.
Hmm.
However, if you're self-employed, you are responsible for 100% of your Social Security and your Medicare tax. Something else I would like to explain, all income is not taxed equally. So different rules apply to different types of income. Maybe I'll let you see. Do you want to give me like a question to address or something? Maybe that'll help me be a bit more targeted in my response.
Let me look at one of those questions that we have. So we have it says, how do I prep for tax season?
Okay.
You know,
Okay.
what's
So that's
a general way to answer that?
okay. So that's a very good question. For tax season, I believe from about January, about mid-January, you begin to receive documents. What I will advise, get a big manila envelope or a folder. Everything that you get that says for taxes, put everything in that folder. If you're a business owner, make sure your books of records are up to date. Have you captured all your expenses? Hopefully you have a good bookkeeping system and good accounting system. So you've recorded all your income and expenses. If you're self-employed, have you been tracking your miles? That is one place I see people miss a lot of deductions for the self-employed persons, tracking your miles. Because if you drive a lot, for 2023, I believe it's about 65 cents a mile. So imagine if you're driving about 20,000 miles for business. At 65 cents a mile, you're talking of over $10,000 in deduction. So it's about keeping proper records, being prepared. And sometimes some of your, maybe if you own investment accounts, some people send you your documents electronically. So go on your account, make sure you download all your investment account statements. Sometimes, so that's why I see where people miss it. Because they did not receive a physical copy, they think they don't need to file it. No. If you have investment accounts, some people will tell me, oh, but I did not sell anything. If you received dividends and reinvested those dividends, it is taxable as well. So the first step is to gather all your tax documents. Hopefully, if your tax preparer sends you an organizer, yes, it does look like it's a stressful thing, but it really helps your tax preparer make sure that they don't miss anything that they need to look at, both in your income, your deductions. The tax organizer is a very good checklist. So go through, gather all your income and expense items, put them together, and send them neatly tied up to your tax person.
All right. So this tax organizer, is it possible to have them ahead of time?
Ahead of time, in a sense, yes. But typically, sometimes Congress or whoever, they don't approve things till the very end of the year. So the earliest you probably can get them will be like in January. And again, sometimes you can even use the one I gave you last year. Maybe the changes will not be so different from the year before. So you always have that template to use to gather the items you gather.
Gotcha. Okay.
Yep.
The next question is how to, let me see, it says red flags or audit triggers.
Okay. So red flags and audit triggers. First, I'll address for maybe employees. Like one of the things I just said is maybe when people receive their documents online. I've seen situations several times where people have received income, but they didn't report it. Not because they don't want to report it, but just because they didn't think about it. Investment accounts, investment advisor, capture all those things because the IRS uses a matching system. So let's say you have accounts with, let's just say, Edward Jones. And let's say Edward Jones reports that they paid you dividends during the year and they sent you your statement online, but you file your tax return and you don't report that dividend that Edward Jones paid you, maybe $20 or $50. So the IRS will show that someone paid you dividends, but you did not report it. So that's one. Make sure you're capturing all your income items. Another red flag, if you own a business, keep proper record of income and expenses. Sometimes I see a situation where some business owners will send me maybe a P&L, profit and loss statement, and all the numbers are even numbers. Revenue, 20,000, supplies, 1,000, office expense, 5,000. Everything is an even number. That by itself, I can guarantee is an audit waiting to happen. Because we all go to the grocery store. How many times do you see anything that is just an even number? It doesn't happen. So if your tax return is showing all even.
Uh-oh. We can see you, we can hear you if you can hear me. Sorry about that. We hope she'll be able to come back. That was interesting.
Sometimes, yes, it takes a while
Okay.
for businesses to record a profit. Let's say they expect you to report some profit at least 2 years in a 5-year period. But if every year you're constantly reporting losses, that is a red flag. Because who goes into business just to make losses? So the IRS expects you to have some profits at some point. And then again, not just profit. If your deductions seem to be above the average, because when you register your business, the IRS knows what industry you're in based on, if you check the beginning of your return, if you're a Schedule C, it will ask what industry is it, service, what do you do? There's an industry average. IRS tracks all those things. So if they compare what you're doing to the industry average, if yours is a complete outlier, that's a red flag. So those are just some of the things that will probably trigger a double look at your information. And the thing with the IRS, if they find a mistake, then they'll keep coming back to check. So you're better off trying to get it right the first time. So even if they do audit, if they don't find anything, then they'll let you go.
Okay, let me be sure that we don't have.
Is that good?
Here. Yes, ma'am. I want to be sure.
Okay.
Okay. All right. Let me give you
Ready?
one question. Yes, one more question. So I see
looks
here.
like we have a little. Looks like it froze.
Oh, I froze. Can you hear me now? Can you hear me? Can you hear me now? Sorry about that, guys. We have a bit of technical issue. Can you hear me? I can hear you. Can you hear me? All right. Can you hear me?
Hello? Okay.
You can hear me now?
Yes, I can hear you now.
All right. We couldn't hear you for a bit, but we could see you.
Okay.
Yes, ma. So we want to find out, one of the other questions that we have is itemize or standard deduction. I mean, what can you say about that? I know you said some things in between while you were talking, but yes, so we like this deduction now. We like to tell us a bit.
Okay. So when you file your tax return, there's the IRS, before you pay any taxes, there's what is called standard deduction, which means the IRS says, okay, without proving anything, depending on your filing status, if you're single for 2023, the standard deduction is 13,850, something like that. And then if you're married, it's 27,000, I think 700. And then if it's head of household, I think it's 19,100. So the standard deduction is okay. you're filing a tax return without proving anything, you can have the standard deduction. However, if you have more items and it's higher than that standard deduction, then the IRS expects you to itemize. And the items that go in for you to consider if you have more than the standard deduction: mortgage interest,
Okay.
real estate tax,
Okay.
charitable donations,
Okay.
cash and non-cash charitable donations, either charitable miles or medical miles. Those are just, they give you cents, so that's not a lot. And then medical, but medical is a tough one to meet because it has to be over 7.5% of your income for it to make any difference. But those are the items. So if you, like I said, like for married filing joint, your standard deduction is 27,700. So if you have mortgage interest, real estate tax, charitable donations, more than 27,700, then I. But if you don't have those items to that limit, then you go with the standard deduction. Of course, it's a bit more intricate than that, because even with all that, there's something called the SALT limitation. Yeah, state local taxes. After the 2017 tax law change, the deduction for the state's local taxes, real estate and local taxes, was limited to 10,000. So like a place in Texas, I know your real estate taxes are quite high. Yeah. So if you have real estate tax and then they give you a little bit too for state sales tax.
Yes.
So if you the sales tax and the real estate tax, like if yours comes up to 14,000, it will be limited to 10, no matter how much it is. Limited to 10. So you have the 10,000, and then let's say your mortgage interest is, let's say, 13,000. So you have 23,000 right there. And then let's say you have charitable donation. If your charitable donation is less than 4,000, then it won't make any difference because that deduction is higher. So you go with.
Gotcha.
But if you add your standard to that and you're above 27,700, then go.
You're good.
Yes.
Okay, guys, I hope that helped. So another one that we have here, okay, taxes and home buying.
Okay.
Tell us.
Okay. Taxes and home buying. So we know in America, most of us buy houses with a mortgage. So for a bank to give you mortgage, that means they are loaning you money. And if they're going to loan you money, they want to see that you have the ability to pay back the money they're loaning you. So this is where your tax return comes in also. They look at your tax return to see your income that you're making, and they check your income to the ratio of the mortgage you're trying to get from the bank. So sometimes some people make this mistake all under the guise of not wanting to report high income. They get, like I talked about red flags, have all kinds of deductions that lower their income. But that can boomerang, because if you go to the bank and you're needing a mortgage, a loan, and they look at your income, but it cannot justify the loan you're asking for, then you can't get it. So it's advisable to get your financial house in order. Make sure your tax returns are in order. The income level you're reporting, what house do you want to buy? Will you qualify for the mortgage you're trying to get? So that is how taxes affect your home buying. Of course, there are different things also that play into it, because if like you're a real estate investor and you have like a bunch of rental income, but then you have depreciation. Depreciation is like a paper expense. The bank will know how to adjust, because you can have rental income of about 100, 200,000 and have depreciation of 150,000. The bank knows how to adjust for things like depreciation. but not things like where you're having losses that reduce your taxable income to the barest minimum. I
Wow.
hope some.
Wow. Okay. So we should be mindful of the free, you know.
All this
Okay.
lowering your taxable income to the barest minimum is not always to one's best advantage. Something else that can count against lowering income, especially like if you're self-employed, for self-employed people, if every time your income is so low, it means you're not paying anything into Social Security or Medicare. When one gets to that age to draw money from Social Security and Medicare, if you haven't put in much, then you're not going to get much, because it keeps track of whatever everybody puts in, and that is how they apportion whatever ratio anyone can get out of it as well. Yeah.
Guys, I don't know if I'm helping, but send your questions if you have a particular one you want her to tackle. Well, the last thing I see here, it looks like you've touched on it, is deductible expenses.
Okay.
That's the last thing I have here. And then the floor is yours to enlighten us some more.
Okay.
Still have about 7 minutes to go. So
Okay. So there are deductions and there are credits. They work differently on your taxes. First of all, we talked about the standard deduction, and we mentioned things that go on the standard deduction list. So that is different. We talked about mortgage interest, real estate tax, charitable donations, sometimes investment interest, charitable miles, medical expense. Like I said, medical is a tough one because it has to be over 7.5% of your income to make any difference. Now, besides that, if one is an employee, which means you get W-2, really can't take any deductions outside of those that I've just mentioned, just the standard, the one that goes on your itemized deduction. So if you're going to use the standard deduction, then it won't make any difference.
okay.
However, if you're a business owner, there are legitimate business deductions. The IRS will check, is this expense necessary and reasonable for your business? So, like for the work I do, I purchase a lot of office supplies, laptop, telephone expense, things like that are considered necessary and reasonable. But I can't go out and splurge on a Gucci purse and say that's a business expense. No. So the thing, it has to be necessary for your business, not necessarily what you think is necessary, because there's the objective person out there going to reach the same conclusion as you, that that item was necessary and reasonable. So that's deduction. So things like office supplies, advertising, internet expense, computer expenses, even meals and entertainment. If you take your clients out to meetings and you buy meals for them, it will be deductible. If you pay wages, you employ people to work, even to employ your kids, depending on your situation, it can be a deductible business expense also, but they have to be doing office work, not doing housework and you claim that on your business. No, it has to be office work. You pay them for office work. And retirement plan contributions, rent, if you rent items for your business, so that will count. Now we have credits. Deduction, what a deduction does, it just lowers. Let's say your income is, let's say revenue from the business is 100,000, and then you have like office expense 20, supplies 15. So you just deduct all that, and then after you deduct that, maybe your taxable, your income from the business net profit will be, let's say 50,000. So that's a deduction. Credits are different. If you qualify, there are different kinds of credits. There's a child tax credit, there's education credit, adoption credit, retirement savings credit. There's a plethora of credits. Some of them are subject to your income level. So some you can get based on your income, some you can't get if your income exceeds a certain amount, where they say you have phased out of that credit. Credit reduces your tax liability dollar for dollar. So if you qualify for certain credits, it is very good, like education credit, child tax credit. Those are very good. Like depending on your income level, you can get about $2,000 in child tax credit for your kids under the age of 17. Also, depending on your income level, for people that have college expenses, there's American Opportunity Tax Credit, there's Lifetime Learning Credit. American Opportunity Tax Credit, I get up to $2,500 in credit. So if your tax liability was $10,000 and you have, let's say you have 2 kids, you qualify $2,000 per child. So if your liability is 10,000, credit of 2 kids, 4,000, your liability goes down to 6, because that's 10,000 minus 2 per child. And then let's say you get the American Opportunity Tax Credit for education, 2005, less another 2005 in your taxes. So it brings down your tax liability. That's what a credit does. And for credits, there are refundable credits and non-refundable credits. The refundable credits are the ones that even if you don't have a tax liability, you will still get it. Like sometimes, like you'll have like some foreign students, they are not working in America, but they're entitled to that education credit. That education credit, American Opportunity Tax Credit, is actually split into 2. 1,500 is non-refundable, which means that can only be applied to a tax liability. But 1,000 is refundable. So even if they don't have a tax liability, they can get that $1,000 back. They just need to file a tax return, submit it, and they'll get the 1,000 back. So that is a refundable credit. The
Yeah,
child,
I'm
yeah.
sorry to cut you short, man. We have a question, and just for lack of time, there's a question that says, "Can I open a Roth IRA for my kids? Can that be a business expense?"
So to open an IRA for your kids, they need to have earned income, which means sweat income. You can't just dash your kids money and go open a Roth IRA. So do they have wage income? Did they earn income from W2 somewhere? That is the money you will have to use to open a Roth IRA for them.
So can that be from your own business?
Yes. Yes. Like if you hire your kids, you can pay them, turn around and put that money in a Roth IRA. Yes, you can.
Okay.
Yes.
Okay. So what's the proper way?
Good,
What's the proper way to do that?
the proper way to do it? Yes, just make sure you follow the rules. You treat your kids like regular employees, file the payroll, quarterly reports, and all that. End of the year, issue them a W2. So let's say end of the year, you paid your child $10,000. So turn around before April 15th, talk to your advisor or go to a bank that can sponsor an IRA, open a Roth IRA account for them. Has to be done by April 15th.
All right. The person said thank you. Okay, ma. All right. So guys, it's 1:29, and thank you so much, ma. It looks like it went so fast.
It does.
We're gonna put Ms. Dumkele's phone number. Can you give us your phone number so I put it here so people can have it, or whatever, your email address quickly?
Phone number 615
Okay.
310 6256.
310-6256.
Yes. Email dumkele
Okay.
at kelanif, KELANIF.com.
KELANIF.com.
.com.
Okay.
And
Guys,
for business owners, explore. There are lots of tax planning strategies out there. And the thing with tax planning, you do not wait till the following year. Tax planning has to happen. Like for 2023, you should have done your planning already. In January, it's too late.
okay, guys, we have to go. Please reach out to her on these contacts, and then let me know if you have more questions. Thank you so much, ma. Thank you. We're grateful to have you.